Two stories are unfolding over the same skyline. One is a crackdown. The other is a quiet flight. Start at street level. In New York City, state officials say more than 150 rent-stabilized apartments were illegally deregulated across Brooklyn and Queens. The purchases date to 2019. 31 buildings. Names and neighborhoods you know: Greenpoint, Williamsburg, Sunnyside, Astoria, Long Island City. The allegation is stark. 159 regulated homes were converted to market rate, some marketed as luxury lofts with rents as high as $6,500 per month. When the scaffolding came down, the prices went up. And tenants, many of them anchored by the rent laws that cover pre-1974 buildings, were left to navigate a maze of reassignments, changing apartment numbers, and listings that omitted any mention of stabilization. Now tilt up to a glacier tier. After the city's mayoral election, brokers in Miami Beach say inquiries from New York buyers surged. At one beachfront development, interest from New York prospects jumped by 166%. The inventory on offer there starts at $10,000 and reaches $125,000 for penthouses. In Coconut Grove, 15% of new buyers at a Four Seasons branded property now originate from the New York City area. Price points in that tower span from about $6,000 for 2 bedrooms to $18,000 for larger homes. Some buyers who had been on the fence moved forward the day after the primary and again during the week of the election. The story at another waterfront tower, where 2-bedroom condos start around $12,000, $500,000, and 4-bedroom residences reach about $70,000, was similar. Inquiries from ultra-high net worth New Yorkers intensified. This split is the through line. Enforcement pressure pulling one end of New York's market back to the law. Capital pressure pulling the other end towards South Florida's beaches. And in the middle, a profound supply squeeze tightening across the country, with New York singled out for what comes next. Shortages of top-quality office space, a broad pivot to high-grade assets, and a slow reset in housing activity that favors the city's suburbs. Let's map the causes. Costs are rising into 2026. In the United States, all-in cost inflation for construction and fit-out is projected to be in the range of 3.5% to 4%. Debt costs and payroll expenses are elevated. That forces owners and occupiers to interrogate every budget line, to optimize space, and cut waste. 72% of corporate real estate leaders now place cost and budget efficiency at the top of their priority list. Pressure is forcing precision. Development is slowing at the same time. In the U.S., office completions are set to fall by 75% in 26, and 3/4 of what's still in the pipeline is already pre-leased. That means less new space, fewer options, and rising rents for the best blocks. In Europe, new construction starts are at their lowest levels since 2010, and deliveries are projected to decline by 5% in 2026 after a 5% fall in 25D. Industrial and logistics deliveries are expected to be 42% below the peak reached in 2023. Multi-housing development in the U.S. is down by more than 3/4 from its recent peak. Meanwhile, data center capacity is forecast to increase by 19% in 2026. The power grid is straining to keep up. Data center electricity demand is projected to have risen 22% in 25 and to more than double by 2030. These forces collide in New York. Stakeholders describe a stable market for luxury multifamily, affordable and workforce housing, high-end retail and Class A office. At the exact moment, lower-tier office and retail assets continue to underperform. Activity is local, block by block. And with a new mayor's agenda on the table, owners, tenants, and investors are watching what policy might shift in the months ahead. On the rental front, enforcement is already here. The state's lawsuit lays out a simple equation: buy, renovate, deregulate. Investigators say the properties were in average or good condition when purchased, failing to meet the threshold for the rehabilitation exemption used to remove apartments from stabilization. In one Greenpoint building at 11 Greenpoint Avenue, the transformation from stabilized to luxury loft was captured online. Unit 1F was listed at $6,800 a month. The last recorded legal regulated rent for that same home was $1,194.38. Another unit, 3L, previously known as 5B, was advertised at $4,800 per month, up from a last known regulated rent of $1,331.01. The building was built before 1972, placing it squarely under the rent stabilization framework, and the marketing described it as a fully remodeled boutique. The alleged tactic of reassigning apartment numbers, the state says, made it harder for tenants and regulators to follow the legal trail. If proven, the numbers tell their own story. The jump from $1,194.38 to $6,800 is a difference of more than $5,600 every month, from $1,331.01 to $4,800, a difference of roughly $3,469 per month. The suit seeks repayment of overcharges and damages. That's not just about the tenants in those two apartments. It's a signal meant for landlords across the 5 boroughs. The rules will be enforced. Paired with the city's growing appetite for high-quality assets over dated ones, the result is a market that rewards compliance, transparency, and best-in-class product, and punishes shortcuts. Zoom back out to how space itself is changing. People no longer tolerate bad experiences at work, in retail, or at home. Across the built environment, experience has become a decisive value driver. In offices, 66% of employees say their employer has a clear in-office policy, and 72% view it positively. But showing up depends on whether the space feels worth the commute. 73% say more greenery near their workplace would improve well-being. 74% prefer places that recognize and tailor to them. When employees rate their workplace experience highly, 84% also feel positive about attendance expectations. And the dollars follow. Offices located in lifestyle districts with amenities, from waterfront attractions to entertainment venues, can command a 32% rental premium. In this environment, New York's bifurcation makes sense. The best assets, luxury multifamily, high-end retail, Class A offices, draw interest. Lower-tier properties sink. Losers are not just dated buildings, but dated experiences. Winners marry location, amenities, and a frictionless path from street to seat, from lobby to a life. There is also power, literal power, to consider. Energy costs can account for as much as 26% of rental value. In areas near major data center hubs, electricity prices have spiked as much as 267% for a single month over the last 5 years. That volatility pushes occupiers to seek resilience with on-site generation and storage. Assets that integrate distributed energy solutions can unlock revenue uplift of 25 to 50% compared to rent. For New York, where grid constraints and electrification are top of mind, the convergence of buildings and power is not abstract. Data centers may not be sprouting on every block in Manhattan, but demand for reliable, clean, and affordable power is already shaping competitiveness, from midtown towers to outer borough logistics. Capital is shifting too. The aggregate wealth of billionaires has increased by 265% since the global financial crisis, reaching an estimated $15.40 trillion in 25. New channels may widen access further. Retirement plans can now include private real estate funds, bringing a broader investor base into private markets. That's the macro picture. The micro picture is the Mamdani effect, the phrase used by brokers to describe how a single election can nudge behavior at the ultra-high end. A 166% spike in Miami Beach inquiries from New York buyers at one property. 15% of new buyers at a Coconut Grove tower from the New York area. A 10% rise in interest in the weeks following the election. Deals inked a day after the primary and again during election week. Price tags starting at $6,000, $10,000, $12,000, $500,000, and going to $70,000 or $125,000. That migration is not a wave. It's a trickle. But trickles can carve stone. Paired with a slow reset in national housing, the pattern could reshape the map of demand around New York. Affordability is expected to improve in 26, enough to thaw a frozen market and push sales up. The recovery will be long and slow, not a quick fix, and not enough to make home buying affordable for most younger buyers in the short run. But it could reanimate the places that suit the new commuter. The hottest areas will be the city's suburbs, where people who need to reach Manhattan can cut costs versus living inside the 5 boroughs. Simultaneously, the Midwest and the Great Lakes are projected to heat up. Those regions offer relatively affordable housing and, crucially, are seen as safer from natural disasters like wildfires and floods, the very events that have contributed to higher homeowner insurance premiums across much of the country over the past 5 years. It's a calculus that mixes climate, cost, and career. Smaller cities in those regions offer recent graduates affordable rents and paths into stable blue-collar roles as automation and AI rewire some entry-level white-collar jobs. The counterweight sits in places that were pandemic boomtowns. Some of the hottest markets of 2022, coastal Florida and Texas, are expected to cool. Demand has dwindled as return to office pulls people back toward where their employers are, and the cost of housing has jumped. Inventory has surged, putting downward pressure on prices. In those markets, some people who need to sell may be forced to take a loss. For New York buyers looking south, the paradox is clear. Better deals may appear in the very places attracting new interest. For New York sellers eyeing those markets, pricing discipline becomes essential. Back in the 5 boroughs, the commercial side is in transition, with U.S. office completions falling 75% in 2026, and 3/4 of the remaining pipeline already spoken for. Occupiers looking for new, large blocks of space will find fewer options and higher effective rents. The shortage of top-quality offices will be acute in cities like New York, where demand at the top end can broaden quickly through a limited inventory. That dynamic is amplified by the need to reposition or retrofit older buildings at risk of obsolescence. Across the 10 largest office markets for repositioning, more than 130 million square meters of space is at risk of stranding. Cities such as New York are counted among the places with compelling opportunities to convert and modernize, moves that can cut embodied carbon, speed delivery versus ground-up builds, and reduce operating costs. Energy-focused upgrades are particularly potent, with returns that can be 55% higher when initiated earlier in a building's life cycle. On the technology front, the results are uneven. Into 2026, a large majority of occupiers and investors launched AI pilots in 2025, 92% and 88% respectively. Yet only 5% say they achieved most of their goals. 60% of investors still lack a unified technology strategy for their portfolios and asset types. 70% of occupiers lack a change management framework for AI. Half say they are not sufficiently resourced in terms of digital and AI talent. The experimentation is broad. The scaling remains rare. That matters for New York landlords and tenants trying to drive efficiency, personalized experience, and cut costs at 3.5% to 4% inflation. Policy sits over all of this. In December 2026, the 5 local players described a stable New York market for luxury multifamily, affordable and workforce housing, high-end retail, and Class A office. Lower-tier office and retail assets were underperforming. Activity was highly localized, and attention had turned to whether Mayor Mamdani's agenda would bring meaningful shifts in the months ahead. On the enforcement side, the rental case seeks to claw back overcharged rent and damages, a hard line that dovetails with the city's broader focus on housing affordability. On the migration side, the great high-end rethink the pull to Miami's Trophy Towers at $10,000 or $70,000 suggests that tax, lifestyle, and political signals can move capital even when the broader market cools. What does it feel like at the unit level? Consider the Greenpoint example as a short, sharp vignette. A tenant in apartment 1F at 101 Greenpoint Avenue sees a listing that places their home at $6,800 a month. The legal regulated rent on the books is $1,194.38. That gap, more than $600 each month, represents nearly $67,000 a year. On the next floor, apartment 3L, previously 5B, is listed at $4,800 with a recorded legal rent of $1,331.01. That's a spread of about $3,469 per month, or more than $40 annually. Multiply that by 159 apartments, and you begin to see the stakes. The mechanics matter. Pre-1974 construction places the building squarely under the rent stabilization umbrella, and the housing law exemption used to deregulate requires serious, documented rehabilitation of deteriorated buildings. State officials say these properties were in average or good condition when purchased. The suit alleges a strategy to market apartments to young professionals willing to pay high rents without regard for stabilization rules, with reassignments of apartment numbers making oversight harder. If courts agree, the remedy will be specific and financial: repayment of overcharges and damages. Shift to the boardroom. Teams picking their path into 2026 confront a checklist. Control costs. Reduce footprint where possible. Upgrade where returns justify it. 72% say budget efficiency is their top concern, and with energy accounting for as much as 26% of rental value, retrofits that lower utility spend can hit both operating expenses and ESG targets. With logistics deliveries 42% below their 22-3 peak and retail supply at near all-time lows in mature markets, New York's distribution hubs and prime corridors are in a position of strength. On the living side, multi-housing deliveries are down by more than 3/4 from peak. That tighter pipeline converges with a forecast improvement in affordability, nudging sales up from a low base and focusing attention on the city's suburbs where commuting remains viable. Then there's experience. The positives in lifestyle districts can command a 32% rental premium. 66% of workers understand their company's attendance policies, and 72% feel positive about them. But they respond to design. 73% want more greenery. 74% want personalization. When those expectations are met, 82% feel positive about showing up. In New York's most contested blocks, that is an edge. In New York's most underperforming corridors, it may be the only way to climb out. Over all of it hangs power. Electrical, political, financial. Data center capacity is set to grow by 19% in 2026, a capacity that will siphon land, grid access, and capital. Electricity prices near data center hubs have spiked as much as 267% for a single month within the last 5 years. As energy markets grow more volatile, buildings that generate, store, and orchestrate power can secure a 25 to 50% revenue uplift compared to rent. Owners that move early, research suggests, see energy-focused improvements deliver returns 50 to 5% higher than those who wait. This is not a niche play. It is quickly becoming the dividing line between resilient assets and stranded ones. Meanwhile, the democratization of access to private real estate is slowly beginning. Retirement plans can now offer private real estate options. Combined with a global increase in personal wealth, billionaires' collective wealth up 265% to $15.40 trillion in 25 more capital is poised to look for stable income and appreciation in property. For New York, that could mean new sources of demand for affordable and workforce housing partners and for luxury co-investments. It could also mean a broader investor base pressing for the data, experience, and energy upgrades that drive performance when costs are rising at 3.5% to 4%. That brings us to what's next. Base case, 2026 looks like a slow thaw. Affordability improves enough to push sales up from a frozen baseline. The hottest areas are likely to be the city's suburbs, where commuting into New York City remains feasible at a lower cost than living in the core. The best assets in the core continue to draw interest. Class A office, luxury multifamily, high-end retail. Lower-tier office and retail struggle unless repositioned. New top-quality office supply is scarce, with U.S. completions down 75% and most new space pre-leased, so occupiers needing large blocks pay up or adapt. 2 watch items are clear. First, enforcement outcomes and policy direction in New York City through December 2026. The suit over 159 apartments, stretching across 31 buildings and alleging increases from $1,194.38 to $6,800 and from $1,331.01 to $4,800 signals a sharper stance on rent stabilization. The result will ripple into underwriting, renovations, and acquisition strategies in Brooklyn and Queens neighborhoods like Greenpoint, Williamsburg, Sunnyside, Astoria, and Long Island City. Policy choices under the current mayor will affect the balance between luxury development, affordable and workforce housing, high-end retail, and the large stock of lower-tier office and retail assets in need of repositioning. Second, power constraints and migration signals through the end of 2026. Data center growth of 19%. Episodic electricity price spikes as high as 267% for a single month, and energy costs that can reach 26% of rental value will influence which New York assets attract capital. At the margin, high-end buyers who drove a 166% spike in Miami Beach inquiries, 15% of new Coconut Grove Tower purchases, and 10% bumps in interest after the election will test South Florida's pricing against New York's offerings. If affordability improves nationally and inventory surges in former boomtowns, some sellers in Florida or Texas may accept losses, resetting comps and indirectly reshaping outbound options for New Yorkers. Between those watch points sits a mix of risk and upside. On the risk side, AI pilot fatigue, where 92% of occupiers and 88% of investors launched programs in 2015, but only 5% achieved most goals, can delay the operational gains needed to offset 3.5% to 4% cost inflation. On the upside, assets that embrace experience, retrofit early, and integrate on-site energy can earn rental premiums of 32% in the best districts and capture 25 to 50% revenue uplift beyond base rent. The market is splitting, as it has been through December 2027, toward high-quality assets with embedded advantages and away from those that cannot justify the commute, the bill, or the carbon. New York real estate is not one story. It is many, stacked. A lawsuit filing that looks back to 2019 and 159 homes, a boutique listing at $6,800 against a legal rent of $1,194.38. A penthouse 1,000 miles south at $125,000, magnetizing a 166% spike in calls. A city where the top end of office demand stabilizes while lower-tier assets lag. A country where U.S. office completions fall 75% in 26, with 3/4 of new space pre-leased, and where multi-housing development remains more than 3/4 below its recent peak. A grid that will be asked to power 19% more data center capacity in 2016, even as energy can take 26% of rental value, and monthly electricity prices can spike 260 to 7% near digital hubs. A workforce that wants greenery, personalization, and a reason to show up, 70 to 3%, 74%, and 80 to 4% tell you exactly how much. In that stack, New York's path is both precise and possible. Enforce the rules. Upgrade the stock. Invest early in energy resilience. Bet on experience over occupancy. And watch the suburbs. That is the base case through 2026. A slow, steady reset centered on quality, compliance, and the commute. If you want more clear-eyed breakdowns grounded in hard numbers, stay tuned and share this with someone who cares where New York is really headed.